Hi, thanks so much for tuning in. You're watching BQ Prime. My name is Alex Matthew. And as we look at the screen, you have the equity markets here in India that are falling. They are falling in tandem with the rest of the globe. You saw earlier today the Asian markets opened weak and continue to trade weak. And we are moving along the same lines. And this is, of course, on the back of quite a big development overnight from the US that had the rating of their long-term debt slashed by Fitch Ratings, and that's had an effect. It's had a risk-off sentiment push across the rest of the markets in the globe as well. Neeraj Shah is joining in, and we will soon have experts kind of give you a sense of how the Indian markets in the context of what is playing out in the globe. So first, Neeraj, to lay the context, how do we look at markets right now?
If I'm coming through well, Alex, then the scene looks a bit wobbly, you have to admit, but it's the first day. Let's not be alarmed. Most people have said that this is a contagion effect that is happening of what happened in the US markets. We know the US futures are down as well, as a result of which European markets, US futures all being down is leading to our markets doing what they are doing. And I'm sure that the charts will look slightly wobbly right now. But the interesting thing is, Alex, that I think you have Dr. Sikinara at some point of time, and he wasn't quite necessarily as non-constructive. So it'd be lovely to understand how do the charts look here. But key point here, Alex, to my mind, is that this is a day event. We don't know how terrible could it be. This could well be the reason why the markets get the much-needed consolidation / correction because of the valuations that we probably are trading at.
In fact, you mentioned Dr. C.K. Narayan, and he is joining us right now, Neeraj. Dr. C.K. Narayan, thank you so much for joining in and for taking the time. Viewers, you will know Dr. C.K. Narayan. He writes a column on a regular basis for BQ Prime. He is founder of NeoTrader and Growth Avenues. Doctor, to start with, Neeraj has kind of laid the context, and I'm hopefully presented a bit of a context as well. And if I read from your most recent column with us, you were talking about some of the elements at play even before yesterday's event. And that had to do with foreign institutional investors kind of turning and pressing the sell button a little more. How are the charts developing as you look at the screen today, though?
You see, we have to see the whole thing in the context of what has been going on. We have a decline today. Of that, there is hardly any doubt. And the decline seems to be pretty decent. Somewhat larger than what we have experienced in recent times. So it does get a little magnified in our minds. Now, if you look at it in the context of what has happened, the market has been on a roll from March of 2023, end of March. And it's been running up for about 4 months and making a series of upward biased kind of moves. So therefore, taking one single day's move, even though it may be large and there was a gap down and all that, taking that one day move out of context and saying that, hey, this is the end of everything, that would not be correct. At least that would not be a prudent way of approaching the market analysis. Now let's see what today's fall has really done. It is on the back of this downgrade by Fitch that we have seen, but markets have seen many such upgrades and downgrades, and they've all been taken in their stride. Second, there has been some global markets which have also softened a bit. So you could say that this is following the other markets, but then the run of the trend in our markets has been so solid that it has simply consumed whatever weakness was there in the other markets at whatever point of time. So we have to side with what is going on rather than anticipate that there's going to be something which shall be very much against what is going on. Now, if something has to go against what is going on, then evidences of that should present itself. Now, if you look at the Nifty, for example, the Nifty future, the nearest swing low that we rose up from was somewhere around 19,370, 380 levels. That's on the Nifty future. And this was as recent as, I think, 10th of July when we had that small swing low. Typically, a market which is showing a strong advance tends to find support at previous swing lows. And even in fast moving markets, the simple rule that everybody follows or technical analysis tells us to follow is that at least two prior swing lows should be broken. Now, if you go and look for the second prior swing low, that is from somewhere around end of June, and that is around 18,680. Now, that's a fair amount of distance from where we are trading. Currently that's about 100 points, say 1,000 points nearly. So I think to pronounce a reversal in the market would be too premature. I think this is a reaction in the market, and so many people have been waiting for a reaction. So a lot of people are also willing to participate in the reaction, A, with abandoning of their long position, B, with stop losses getting triggered, same effect. And C, there are a lot of people who have been waiting to short this market, have shorted, lost money, and they are looking to get a bit of their own back. So there are three types of people, all of whom are willing to sell in this market currently. So this call is nothing out of the ordinary. I would only wait to see if 19,350, 375, which is the last swing low area, that gets taken out, and that gets taken out meaningfully. I don't want to just have a measly poke over there, but if it gets taken out meaningfully, then it might make some sense to look at it, because a rising trend line, which is quite steep right now, a support trend line to this market, will also get clearly violated if that 19,380 goes.
Got it. Dr. Narayan, the put support was at around 19,500. We are at 19,447 currently. I heard you talk about a level which is 100 points below the current numbers. If that were to be violated, would you believe that bears might get an opportunity to go short as well? Because hitherto, short trades have been cleaned out very, very efficiently in the last few weeks.
See, first up, the levels I talked about were in the Nifty future. So that's about 100 points above the Nifty spot. So we are at about 19,540, 550, and 19,380 is where I was talking about. That's one. Second, bears have been wanting to get into this act, but they have been unable to do so because of consistent fund flow. Now, over the last couple of sessions, maybe the FIs have been selling, and there might be some misgiving, but except for a day when they sold some 5,000 crores, I think that was Friday, if I remember correctly, their selling has come down to a much lower level by yesterday. Yesterday was some 90 odd crores, that's all. So the FI selling is going to make a little bit change in the sentiment. Now, see, market trends are actually composed of 4 or 5 elements. The first element I spoke about, that is the price and the pattern. Now, the price and the pattern are still in a bullish hold, because unless you break at least the nearest swing low, even the directional swing does not change. So that is one. Second is the volumes. We are not seeing big volumes on any kind of sell-off, whether even after some poor results, we may see some volumes on individual stock, but overall on the market, we are not seeing it. Third, the sentiment is still one of skepticism about the upside and not about the downside. People are so fearful of the downside that they are not willing to participate. You need the sentiment to change, and a lot of things have to happen for the sentiment to change. And fourth is the momentum. The momentum has been on the upside, and the momentum is still quite intact. On the intraday charts, today's fall may have some momentum. But when we are talking trends and we are talking the bigger picture here, then we are talking about momentum on the daily charts and weekly charts. And I don't think they are really disturbed. Final element I would put for gauging the trend is the factor of time. Now, we have been up and about for about 4 months and more now. And yesterday was one of the kind of a turning date. It was kind of a 90-degree turn. And we are trading slightly below that low today. So in the very short run, that could be possible. But if I expand my perspective to look at time analysis across the whole month, then I am finding that, and this is what I wrote also in my column, that the smooth run that we have been experiencing for so long, that might get a little bit disturbed in the month of August, which I'm finding is full of turn dates every few days, which generally means that the market trend is likely to be more volatile. And in volatile times, especially when you are at high levels, it will look like every turn down is a reversal. I don't take it as such, because I do not have August marked for a big downward signature. Yes, somewhere in the middle of the month, we might see some amount of fulmination. But overall, the time cycles are not pointing to any crash which might come. Prices are not pointing towards it. So I would treat this as a reaction in an ongoing uptrend and would expect some amount of supports to emerge near the previous windows.
Dr. Narayan, you mentioned volatility at the end, and I'm just curious what you think about the VIX, because despite the kind of increase in the VIX that I see today, it's still relatively at lower levels, right? So one, what do you think about that? And while you're talking about the fear in the market of the downside, I'm also curious about what you think about the upside. So do we then, if we don't see considerable selling and considerable move down, do we see a period of consolidation where you don't see significant moves on the upside either?
Well, as far as market forecast goes, that is the last part which you mentioned. Do I see somewhat of a consolidation? Answer to that is yes. I just explained the reasons behind it, because the whole of August seems to be full of volatility, and generally when you have volatility, market tends to consolidate. So because there is so much of money waiting in the wings to buy at lower levels, I don't think the dips will go that far, because consistency of fund flows there towards the market. Dips will also not be anything very deep. The quarterly numbers are still flowing, but the big names are done. And I don't think there has been any kind of fear that, okay, growth has stopped or it's not going to come, etc. So I don't think this quarter results are really going to spook the market. If anything, selectively, they are actually going to provide some amount of triggers or upside impetus. So collecting it overall, the VIX, which you mentioned, the VIX is certainly on the lower side. It's close to 10-11%. And the cliche in the market is when the VIX is high, it is time to buy, and when the VIX is low, it is time to go. So going by the cliche, you should be on the protective side, because 10%, 10.5%, 11% is certainly on the lower end of the bracket. What has happened is also not exactly to be seen from the context of the cliche of VIX, but the kind of market we have had and the kind of volume surges and the kind of participants we have had on the option market side. I think that also needs to be taken into account, and therefore I would not take the VIX indication of being low as a time to really go away from the market. Yes, some consolidation will see the VIX kind of spring back a little, but beyond the consolidation, I'm not really looking for any big drop.
Got it. Dr. Narayan, one word on banks. HDFC Bank, we know, has been there, bogged down by the continuous selling because of the higher weightages coming off, but the other banks haven't stepped to the fore. They are the first to fall down of late, especially private banks. How do any of these look on the charts?
Well, I think the banks have really led the last leg of the market up, right? And HDFC, there were a lot of news flow related to that. One was with Kotak, one was with HDFC banks merging. Then there was this IDFC First, IDFC merger, and there were a series of news flows related to banks which kept on coming. Then the results were pretty good again. So undoubtedly, the leader is under a pressure. Now the leader is under a pressure, but what is this kind of pressure? It is a kind of ranging pressure on the charts. You're not really seeing a big fall. And if you look at HDFC holding, that had come down substantially. It used to be in the high 70%. Earlier came down to about 60, and now then it dropped recently to as low, I think, as about 42%, and now it's a little bit back again post the merger. So I don't see the big players letting go of HDFC after this merger and all. This is all readjustments relating to the merger. I think the worst case that you might find on HDFC Bank would be something like 1600, which is say about 50-60 rupees below the current levels. Now that is not going to seriously damage any banking trends. And at the most, again, banks will consolidate because all of them have had a decent run. Kotak Bank with the succession affair again, that's a bit in the news. And only ICICI Bank is kind of flying the flag for the sector as of the moment. So I think if banks were to consolidate, given their large weightage in the Nifty also, and we are looking at time cycles and sentiment and overseas influence, etc., all of them contributing to a possible sideways consolidation, the banks should be at the forefront of that consolidation. And HDFC Bank is all, kind of indicating that sort of already, saying that I'm more interested to consolidate here and get my house in order as far as market positionings are concerned. And then subsequently maybe show a move post end of August or something.
Dr. C.K. Narayan, thank you so much for joining in and for giving us that perspective. It is very apt, and I think a lot of our viewers will benefit from what you've just said. And I do look forward to your column this week as well, because I think that's going to give us a lot more perspective over the next couple of trading sessions as well. All right, so there you have it. And Neeraj, based on what Dr. C.K. Narayan is saying also, consolidation seems to be the name of the game, at least on the technical charts, and quite a few indicators that he's pointed to as to why he's saying that as well.
Yeah, I mean, Alex, let's be clear. The idea of doing this coverage as well was essentially at both our ends, was not to spread panic in any fashion whatsoever. A 4-5% corrective move after the kind of move that we've had should be expected on any given day. The fact that it is happening after the Fitch rating event has happened is leading people to believe that that's necessarily the cause. It's not necessarily be the only cause, because we know that the markets have run up quite a bit. Almost every guest on the platform has said that you expect these corrections to happen. Today too, there are specific pockets which are actually doing really well on very high volumes. You have the aviation stocks, there is an odd walk hard and a few others which I saw, which are doing volumes which are 4 or 5 times the weekly average. So it's just 1.5%. We can very well connect another 3, 4, 5%, go down all the way to 19,000 as well. Fundamentally, I'm saying, and that shouldn't be a cause for panic. It would probably be a healthy correction. And as the HSBC India equity strategist was saying, that if we indeed go down 4 or 5% from the levels that we were at day before yesterday, then a lot of people might actually look at that as a buying opportunity. So I reckon that's how it might make sense to look at it.
So interesting. And one of the statements that Dr. Narayan made also stood out to me is that if you talk to market participants, they're talking about the upside in terms of how far we will go, and they're not really worried about the downside as well, right? So even that kind of gives you the perspective and possibly leads into that conversation that we may not see significant downside from this point. And what he's saying, and I take your point completely, but we may well see consolidation at these levels and not move for a while, and that is also par for the course.
Yeah, and Alex, 4 to 5% is actually consolidation, right? It's technically not a correction. I mean, 4-5% move can happen in a matter of 3 days, and from 20,000, 5% would mean that we go down, excuse me, all the way to 19,000. So that shouldn't surprise people. The other piece, and I know we are waiting for more guests, but I'll just take a minute here. The other piece to keep in mind is the point that I think Dr. CK mentioned and you mentioned in the podcast as well, Alex, about flows, right? The support of the FI, strong FI flows, is not as strong in this intermediate period right now as it will. But who knows what will happen in August? I mean, expert after expert who's gone to the US is coming out and saying that the flows seem very strong. Though JP Morgan, Sanjay Mukim said that he sees a turn, and if that were to happen, things are separate. But things are okay. Earnings have been decent thus far. The positions have not been very heavy. Mind you, that's the other aspect. If you just saw the rolls into this current series as well, it is not a very high roll figure, and therefore I doubt that the positions are so heavy that unwinding of a serious nature would happen, which might drag the indices lower. So I think that's the other thing to be kept in mind while we're looking at things. But let's not make a mountain out of a molehill. 1.5% can happen any given day.
No, certainly. And in fact, Neeraj, correct me if I'm wrong, because you've seen so many more of these periods than I have. But in periods where you have a global pervading risk off sentiment, a seller in the US will sell on APAC, and therefore selling in India perhaps is also incidental. But we've got Jay Bala, who is founder and chief market technician at Cash the Chaos, also joining in. Jay, thank you so much for taking the time, and we'd love perspective from you as well. How are you looking at markets right now? What are the triggers for you, and where do you see things going from here?
Yeah, I'll start with the important macro where I differ from a lot of technicians and macro strategists. It's the dollar index. The dollar index has possibly put in a very significant bottom at about 99 and change. And the print of 101.92 is going to take the dollar index at least to 109 to 111. My thesis, although, is that the dollar index is headed somewhere close to 120 plus from a 18 months perspective. But the decision point will happen around 109, 110. Will even if the least conservative measurement for the dollar index movement is going to be 109, 110. So that's the reason why that's going to be a decision point. And that's going to the recent drop has brought a lot of risk assets into inverse correlation with the dollar index, which wasn't existing before. So the dollar index complete structure is going to have a little bit of impact. And I agree with the other aspects that you're discussing. The Nifty is probably going to go back to test the previous all-time highs of about 1887 and then come back to fresh record highs. That's the thesis I'm working with at the moment.
Today, by the way, incidentally, Jay Bala is mentioning the dollar index. The rupee slid below 82.50 as well. So please keep that in mind. Jay, correlation. So if indeed the dollar index goes closer to the levels that you're saying, or even if it doesn't go all the way there, did I hear you say a level of 18,700 or did I get it wrong?
Yeah, that's right. The previous all-time highs that the markets were consolidating, until that month of May, and that's the retest I'm anticipating the market to do. Whether it's going to be a bullish retest or a bearish retest, we can take a call as the markets head closer there. I think the markets are going to, hold those levels and then get back to fresh record highs sometime around Diwali or October.
Got it. We had Dr. C.K. Narayan Jay talking about August being a volatile month. I reckon you believe it will be volatile with a downward bias. Just one question from my end. What drags the indices lower from where we are right now? Would it be banking? Would it be non-banking stocks? Because IT is already corrected quite a bit. So what do you see?
See, the leaders of this bull run has been the FMCG stocks, capital goods stocks, and the auto stocks. There is an important breakdown today on the Nifty Auto Index below 15,400. So that's going to be a drag on the market. And keep a watch on FMCG index. If that were to go below 51,125, that will complete a medium-term cycle from the COVID lows, and that's going to see a significant correction. So, and Nifty Bank is the other one I'm anticipating. The structure is such that if Nifty Bank were to break 44,500, again, that's another contributor on the lower side. So these are the three sectors I'm anticipating to drag the market lower.
Yeah, I'm curious what you think about the flows, and we were talking about this earlier in the conversation as well. Quite a big contributor to the run-up that we've seen in the Indian equity markets has been foreign institutional investors buying and buying aggressively. Over the last few sessions, we've seen a bit of a turn there. If that increases, what is the implication for the Indian equity market? Or what do you think will happen in terms of the flows based on what you're seeing across the globe?
See, I'll tell you a very important incident. When I was across asset strategist for one of the frontier asset markets, at the time the Swiss had pegged their currencies to the euro, and they had unpegged it after a while, and they came back to sell their best performing assets in the frontier markets, and the markets were surprised a lot. So uncorrelated events can trigger a lot of things because at the time the best performing fund for that frontier market was a Swiss fund. So so all these things will fall in place. So even the flows will come in unison with this thesis that I'm anticipating. But as such, this should keep the markets on a slight negative bias. Whatever be the flow, and supports will come in at these significant levels.
Okay. Now, you've spoken about banks, you've spoken about IT, you've spoken about FMCG. I'm curious about a couple of other big names, right? If you talk about Reliance Industries and what it has done in the recent past, of course, the run-up towards the JFS listing, How do you see that, and what are the implications of a big move for Reliance Industries as well, in terms of the direction that the benchmark moves in?
I'm glad you asked that, Alex. It's a very significant stock and very significant. It's a sector by itself, contributes 10% for the Nifty. And my thesis had always been that the 2850 registered sometime in last year is a very significant high, and that's not going to get taken out for a while. And the recent spin-off of Geo Financials, that has actually came in just right, 15 paise below the all-time high of 2850 and change. So I don't think Reliance is going any higher. The best thing that can happen for Reliance is it consolidates between 2850 and 2200 and stays in this range. The bearish case is something that can trigger sometime over the next 12 months time frame. I think right now it's going to consolidate without breaking between the medium term supports of 2800 and 2200.
Jay, just one question. The heavyweights, between Reliance, HDFC Bank, I'll throw in one or two IT majors out there. And I heard you say that FMCG looks very weak. So maybe an HUL or ITC, which is a crowd favorite. Are you short on any of these currently?
In a short, it can be short on depends on what time frame you want to hold those shorts. Basically, if it's going to be for a few weeks, we can, there's a trading game, right? Definitely out there. But ITC, if it were to go below 440, that will be the contributor for the FMCG index's turn. That's the leader within the FMCG space. HLL has very clear lower high structure, so that's also bound for a correction. If you have a time frame that's say 1 to 2 weeks, yes, definitely there's a short play over there.
And just I'm just trying to get a sense here, and this is based on what you said in terms of the Nifty level. 18,750 is what it's going to test, but what time frame are you looking at?
Yeah, I think it's going to be a very short term, 4 to 8 weeks, nothing beyond that. And as I said earlier, once it does that, I anticipate the market to come back to a fresh record highs past 20,000 mark, just around the 20,500. That's a medium to long term structure that I'm working with. But I'm not anticipating 25,000 like a lot of people. We can discuss that a little later because it's a very long topic. But at the moment, I'm anticipating the previous range to get tested, the 18,800 to 18,400 range, and then the markets come back to the fresh record highs. See, the most important thing is that the Indian bond markets, the Indian 10-year yields, they are headed for fresh multi-month highs that it crossed, clocked in 2022. It's going to get crossed. The 7.15 levels that it touched a couple of days ago, it's pointing to a very significant turn. We're going to have a short-term pullback to 7.03, 7.0506, and then we're going to see a very sharp hardening of the Indian 10-year yields.
Interesting that you point that out. Yes, I was looking at that as well. We're closer to 7.2%, in fact, in trade today for the 10-year yield, and we moved up from 7 levels over the last month or so. Jayabala, thank you so much for taking the time and for speaking to BQ Prime. Neeraj, quick takeaways from those two conversations, insightful. And as I look at the screen right now, we've not moved too much, in fact, right? So, or in fact, we've come off from the day's lows, if anything.
Yeah, from 1% and 1.6% down to whatever we are right now. But I think slightly, not divergent really, slightly mildly contrasting. But if you take into account what Narayan also said, that if we cross below, say, 19,350, then there are some lower levels out there. Limited point, Alex, that both of us talk on the podcast as well. It could happen any given day. This shouldn't be alarm bells. If anything, yes, if you're lucky enough to be smart enough to time the top, keep the gunpowder dry, you might get some at lower levels, but don't be surprised if the market makes a very swift U-turn, India in particular, after a few 100 points fall, because from the looks of it, this time is certainly different.
Absolutely. And we'll talk about that in a lot more detail. Viewers, thank you so much, as always, from Neeraj and myself for joining in. And we've got a lot more lined up over the course of the day, so do stay tuned for all of that. This is BQ Prime.